Hi, big week for markets with the Fed coming up, but of course, oil guys are all, girls guys, are all really excited about the Russian product export ban, which starts this week. Now, of course, the impact of that's going to be in the market because we don't wait till the day and then everyone change behavior. But it'll still be interesting to see what happens. And the most important thing out there in many ways is that we have globally high refining margins. Now, that's difficult in the US, as we keep saying, because there's so much refining downtime in the US. But certainly the picture in Asia, where you've had a significant increase in Chinese exports of products that we thought would be bearish, isn't coming through in Asian margins. And we always say that there's only one good demand number in the market, and that's refining margins. And they're actually strong, Asia, Europe, and US. On the US side, we'll be talking to Valero this week, and we've got results from Phillips and Marathon. So we'll try and establish who's not running. A couple of refiners benefit the independent refiners because, for example, Petróleos Mexicanos, Pemex, is down at Deer Park. Anybody who's not running is essentially benefiting everyone else. And so we'll be looking for those who we think are running well in this environment, and on the other side, those who are not. Looking through the list, there's quite a bit of stuff at Exxon, there's quite a bit of stuff at Valero. We'll ask the management about that this week. We'll ask Marathon about Galveston Bay. That's a huge refinery that seems to have issues, and they'll be doing their conference call alongside Phillips tomorrow. So a little company called Exxon also reports tomorrow, which is unusually. Normally they report on a Friday with Chevron, but this time coming in on a Tuesday and having, unlike much of history, pretty heavily guided. Additionally, Valero had such outstanding results last week. They were truly remarkable results. 95% utilization is what we love. Really running the refineries well, and also benefiting from this wide heavy light spread, a large part of which seems to be a structural new wideness based on the change in shipping fuel speculations, IMO 2020, which impact was really hidden by COVID, but which clearly increased diesel demand and backed out heavy fuel oil demand, which can now be used as a cheap input for refiners that are complex, such as Valero. So the question is, are we really going into a higher sustained margin environment? Because if Valero is going to keep making the money they're making, the stock is on 5 times earnings with a very strong cash return outlook. As I said, as a result of the strength of Valero's results, we'll be expecting good numbers from Exxon tomorrow, unlike Chevron, which kind of missed, has less downstream, had down year-over-year volumes, which people didn't like. And of course, was seen as clumsy in announcing a $75 billion buyback when it kind of really wasn't a $75 billion buyback. The buyback guidance as of Q1 next year is $3.75 billion. They could have just announced that, which wouldn't have got them any heat, I don't think, politically. Then again, does it really matter? I mean, politics and oil, especially the Biden administration and oil, are so discredited that nobody really particularly cares what they say anyway. And that was the impression we got from Chevron, which was just like, yeah, we had to announce a new buyback, so we did. Who cares of what the politicians, they're sick and tired of the politicians, quite rightly. So that's that. And then just ending out the week, we'll have Conoco and Shell. And there's obviously a huge week of earnings for a lot of other very important things. People are very focused on Meta, Facebook, which is on an absolute tear. 25% up this year. And it's interesting to note, for example, Pfizer down 15% this year. J&J, super defensive, Johnson & Johnson down 5% this year. And then the index of unprofitable stocks, the ETF of unprofitable stocks, which is called ARKK, the index of most shorted stocks are all tearing. And so what we're arguing is essentially the market is fighting the Fed. Will the Fed be able to come out with just a 0.25 raise here when the market will probably rip on the news? And may well then cause all sorts of, further problems for the Fed, who are desperately claiming that they want to absolutely smash the inflation that they caused. So it's going to be an interesting week. Apple also reporting, huge number of reports actually, but also, really flipping now from the big oils, the big refiners. With ConocoPhillips, we signal that we'll be moving into the E&Ps. And watch out carefully, ConocoPhillips may have to have a significant increase in their capex. They've got 2 major projects to get through, Willow in Alaska and Qatar LNG. So watch out for a big capex announcement from what has been really the leader in capital discipline. And additionally, Chevron on their call on Friday were highlighting that marginal performance in the Permian is deteriorating. And that's the theme for the E&Ps. So I think the E&Ps may have a bit of a troubled earnings season here based on horrible natural gas prices. Natural gas still looks broken. Based on NGL prices that are arguably even worse, and based on marginal well performance. it's going to be a difficult and probably very differentiated set of performance. Our bet would be EOG does well because of their technical capability. There'll be controversy around Pioneer, and watch out for some of the big NGL plays like Davin, like Coterra, who may really have to suffer with reporting bad NGL realizations because of the weakness and oversupply in the market. Okay, that'll do it. Have a great week. Cheers.